I used to be a blind trader, constantly searching for the holy grail of trading that would ensure success through complex indicators. I believed that the more tools and indicators I had, the more I would understand how to make more money in the market. But I was wrong. All of those tools only confused me and quickly burned through my account. It was a hard lesson, but I changed. Today, I want to share with you a secret that took me 8 years of trial and error to figure out. If you watch this video to the end, you won't need to spend as much time as I did to learn this important truth and will still be able to grasp an effective way to trade in this brutal market. You don't need many indicators like MACD, RSI, or Bollinger Bands. You don't need all those complex indicators that you don't really understand. What you need is volume. 3 types of volume that will help you understand the market's heartbeat. When you truly understand volume, you will realize that the market is not a complicated maze full of false signals. No more struggling with charts packed with indicators. No more frustration with fake breakouts. Just focus on volume. I will tell you this. If you understand volume, not only will you survive in this market, but you will also survive long enough to encounter those lucky opportunities. You won't need to win big. You won't need to become a legend. You only need to survive long enough to grab those opportunities when they come. The market is not a place for those who try to win big quickly. It is a place for those who survive long enough to seize the opportunity. If you can read volume, you will realize the market is giving you signals, and this time, you won't be deceived. So, are you ready to step out of the whirlpool of complex indicators and start understanding the market through what really matters? Now, I want to share with you 3 types of volume that I've discovered over the years. These 3 types of volume will help you understand the market's heartbeat and survive in this game. As long as you understand volume, you won't need to worry about those complex indicators anymore. The first type of volume. Volume spike. The first type of volume I want to share with you is the volume spike. This is the type of volume that I used to fall for and lose a lot of money because I didn't understand it. In fact, a volume spike is very easy to identify. It's when the market shows a candle with an unusually high trading volume that far exceeds the average. But don't be quick to rejoice just because you see the volume increasing sharply. A volume spike is not an invitation to enter. It's a warning. Imagine you're sitting in a room full of people, casually chatting. Suddenly, one person shouts loudly. You don't know what they're saying, but you know something important is happening. A volume spike is like that shout. It could be a large investor intervening, but you cannot rush into the market. Most beginners will think the market is about to make a strong move and immediately enter, but in reality, it could be a trap. I've made this mistake many times. I saw the volume spike, thinking it was an opportunity to profit. But soon after, the market reversed sharply and I lost everything. Volume spikes often come with fake chart patterns, where big investors try to create liquidity to exit their positions. Only those who truly understand the nature of volume can spot it as a trap. What I learned over time is that volume spikes are not an entry signal, they are a warning. They often indicate that the big players are manipulating the market, creating artificial movement to lure retail traders like you into the game so they can exit and leave you stuck. So, my strategy when facing a volume spike is to carefully observe the market's reaction after it happens. If the price continues to rise and the volume remains high, that's when I consider entering. But if after that, the price suddenly drops and the volume decreases, I know it's a trap, and I stay out. The second type of volume divergence. The second type of volume I want to share with you is volume divergence. This is an extremely important type of volume that I learned after experiencing several failures. Volume divergence happens when the price continues to rise, but volume decreases. This is a clear signal that smart money is pulling out. Breakouts without proper volume support are always warning signs. You need to pay attention when the price continues to make new highs, but volume starts to decline. That's when you need to become suspicious and look for signs of reversal. Volume divergence is the market's way of telling you that the strength of the trend is weakening. If you don't recognize this, you'll easily get caught in false breakouts and lose money. I've been in situations where the price was rising, but volume was dropping, and I still believed the market would keep going up. But after a few days, a large red candle appeared, and the price plummeted. That's when the big money had exited. If I had understood volume divergence, I would have avoided that mistake. When I see volume divergence now, I wait for a reversal signal, and I use other indicators like candlestick patterns to confirm the potential reversal. If the price is still making new highs, but the volume is declining, I'll stay out of the market until the volume starts to pick up again and confirms that the trend is shifting. The third type of volume confirmation. Finally, the third type of volume I want to share with you is volume confirmation. This is the type of volume I look for in every trade. Volume confirmation happens when the price breaks out and the volume increases accordingly. This is the signal of a true trend. When volume confirms, you can confidently participate in the market because real money is flowing in. You need to pay attention when the price breaks through a key support or resistance level and volume increases along with it. This is a signal that the market is confirming a new trend. If volume doesn't increase after a breakout, it might just be a false breakout, and you should avoid it. I've traded with volume confirmation and had several big wins. When I see volume confirming a trend, I know that this is the time to join the market. You don't need to enter too early. Just wait for the market to confirm and for volume to start increasing. I used to fall into the trap of complex indicators and wasted a lot of time and money before realizing that volume is the real key in trading. If you understand volume, you won't need to rely on other indicators. You'll know when the market is truly strong, when it will reverse, and when you need to stay out of the game. If you want to survive and succeed in this market, don't be lured by fake signals from indicators. Learn to read volume, and you'll understand the market's heartbeat. Volume will give you signals when to enter and when to stay out. If you've gone through the first part and understand that volume, trading volume, is the most important thing to focus on, now it's time for us to dive deeper into how to read and understand volume in actual trading. You don't need to use too many complex indicators, nor do you need to get confused by hard-to-understand candlestick patterns. All you need is to know how to analyze volume in the 3 types I've shared with you in the previous part. We'll go deeper into each type of volume, learn how to identify it on charts, and how to apply it in actual trading. I'll share with you the strategies I've used to avoid mistakes, and most importantly, how to survive and grow in this tough market. Once you understand volume and how it operates in the market, the next important thing is knowing how to apply volume in your trading strategy. I spent a lot of time figuring out how to trade effectively based on volume. And today, I want to share with you the strategies I've applied to not just survive in the market, but to thrive and earn sustainable profits. One of the most important things I learned in my trading journey is never rush into the market blindly, whether you see the price rising strongly or witness a breakout. You have to know how to read volume to understand what is really happening in the market. Strategy. Based on volume spike. When you see a volume spike, the first thing you need to do is not rush into the market. As I mentioned before, volume spikes often come with actions from big players manipulating the market. These volume spikes could be a trap, pulling retail investors like you into the market only for you to be liquidated later. My strategy when facing a volume spike is to carefully observe the market's reaction after the volume spike occurs. If after the spike, the price continues to rise and volume remains high, that's when I consider entering. But if after that, the price suddenly drops and the volume decreases, I know it's a trap and I stay out of the market. For this strategy to work effectively, I often use candlestick patterns combined with volume. When volume spikes along with a strong bullish candle, but then a large bearish candle appears, I immediately reconsider my position and decide whether to take profits or cut losses if necessary. Strategy based on volume divergence. Volume divergence is one of the most significant signals I always pay attention to because it warns of a weakening trend. When the price continues to rise, but volume decreases, that's a sign that smart money is exiting the market. You need to pay attention when the price is still increasing, but volume is weakening. This is a signal that the current trend is losing momentum and support from big money. Volume divergence is a sign of fatigue in the trend, and if you don't recognize it, you'll easily get caught in false breakouts and lose money. I've been in situations like this. The stock price continued making new highs, but volume kept declining. At that moment, I still believed the market would continue going up, and I entered a buy order. But just a few days later, the price dropped sharply, and I had to close my position with significant losses. If I had paid attention to volume divergence, I could have avoided that mistake. Now, when I handle volume divergence, I always monitor the relationship between price and volume. When the price continues to increase but volume decreases, I know this trend is losing strength. Instead of entering a buy order, I stay out and wait until the price adjusts and volume starts increasing again. At that point, I'll enter a trade against the trend and profit from the market's reversal. Strategy based on volume confirmation. Finally, there's volume confirmation. This is the most powerful signal in the 3 types of volume I've shared with you. When you see price breakout and volume increases, that's when you can confidently participate in the market. You need to pay attention when the price breaks a key resistance or support level and volume increases. This is a signal that the market is confirming a new trend. If volume doesn't increase after a breakout, it might just be a false breakout, and you should avoid it. I've traded with volume confirmation and had several big wins. When I see volume confirming a trend, I know this is the time to join the market. You don't need to enter too early. Just wait for the market to confirm and for volume to start increasing.